Are you aware there is evil lurking within your portfolio? There are two sinister forces constantly at work, creating drag on your investments, hurting the growth of your net worth, and reducing your portfolio's overall gas mileage. Of course, I am speaking of income taxes and investment expenses. Say them again with me and focus on how you feel when you say the words taxes, expenses. Neither concept conjures up feelings of pleasure nor of positivity. As an investor, what exactly are you supposed to do to reduce and manage expenses and income taxes? They are unavoidable and will always be part of your net worth building journey. However, there is definitely good news. Both of these necessary evils of investing are controllable, they are minimizable, and there are strategies to help you reduce them. So stick around, because in this video, we're going to identify 9 specific ways to get better gas mileage on your portfolio, keep more of your hard-earned money, and ensure that these necessary evils are kept in check. Hi, my name is Joseph Eschleman, and I am the president of Towerpoint Wealth, a boutique independent wealth management firm headquartered in downtown Sacramento. And here at Towerpoint, we focus on what we have control over and try to accept what we don't. And we firmly believe that in the world of investing, it's not what you make that counts, but instead what you keep. So let's get into how we can reduce these sinister forces of investing. Necessary evil number 1, taxes, of course. Are income taxes dragging you and your portfolio down, and at the same time reducing your real overall return? While financial and investment decisions should never be primarily driven by tax implications, evaluating opportunities to reduce and minimize the income tax drag of your portfolio should always be top of mind. Here at Towerpoint Wealth, we recommend you consider these 5 strategies to help you minimize the evil of income taxes on your portfolio. 1. The location of where your investments are held is essential. If you have a regular taxable account and also a tax-deferred retirement account, understanding which account to hold which of your investments makes a huge difference. Put plainly, knowing which components of your portfolio to hold inside of your tax-advantaged retirement accounts, such as IRAs and 401ks, can have a significant influence on your net after-tax returns. Investments that pay a lot of ordinary taxable income, while they're nice to own, should generally be held in a tax-advantaged retirement account. Investments that pay qualified dividends or no income at all should generally be held in your regular taxable accounts. Which account holds what investments can play a huge part in reducing your obligation to Uncle Sam. 2. Carefully think about when to buy and sell your investments. Should you sell an investment before or after December 31st? Should you harvest tax losses before the end of the year? How and when to realize capital gains can make a huge difference when reducing the overall tax drag of your portfolio, as well as recognizing and leveraging the differences between short-term gains, which are taxed at federally higher ordinary income tax rates, and long-term gains, which are usually taxed at the lower 15% federal capital gains tax rate. 3. Be strategic about which accounts that you trade in. Should you buy and sell in your tax-deferred IRA or 401k account? Or would it be better to take advantage of the 15% long-term capital gains tax rate that I just mentioned, or even zero tax return of principal opportunities that a regular non-retirement account offers? Each situation is nuanced when considering how to reduce the necessary evil of income taxes, but working closely with your financial and tax advisor can have a huge benefit to how much of your portfolio you end up keeping. 4. To minimize your tax drag, always consider the type of investments and funds that you own. Certain mutual funds trade less and have lower turnover, tending to be more tax efficient as compared to funds that do a lot of active buying and selling, which can generate unwanted income and capital gains distributions. Additionally, exchange-traded funds, or what are known as ETFs, inherently trade less and almost always have a lower tax burden than do regular mutual funds. 5. Be smart about which accounts to make withdrawals from. Don't forget, you are working to build and grow your portfolio to eventually begin taking from and spending it. And it is extremely important that when you begin to consider how to take withdrawals, you are mindful of the type of account you decide to draw from, your tax status in the year of the proposed withdrawal, and your potential future tax status. Again, these are nuanced planning points, but all extremely important when keeping Uncle Sam at bay and reducing the tax drag of your portfolio. As we say in Philadelphia, bada bing, there you have it. 5 ways to minimize the necessary evil of income taxes on your portfolio. Did you find a few of them valuable? Let us know by clicking that thumbs up button and leave us a comment as well. Now on to necessary evil number 2, investment expenses. According to a study by Consumer Reports, 4 out of 10 investors do not know how much they are paying in fees and investment expenses. This is unacceptable, as we have to know who our enemies are and keep them close to us. One of the easiest ways to bolster your returns and better grow and protect your net worth is through expense, fee, and cost reductions. Here are 4 things you can do today to keep more of your money and have more of it working hard for you. 1. Own low-cost index funds and ETFs instead of actively managed funds. In the world of investing, you don't receive a bill in the mail to pay for the internal costs and investment expenses of your diversified investment funds. Instead, you pay for these expenses directly from the gross return of your funds. This is money earned but never seen, and while some may argue that active management might be worth the extra cost, we believe at Towerpoint the empirical data says otherwise. 2. Reduce or eliminate account custodial fees as well as trading commissions and costs. It is simple. Research and then use a custodian or brokerage firm that doesn't charge for these things. At Towerpoint Wealth, we believe this is an absolute no-brainer, and one of the many reasons we have partnered with Charles Schwab as our custodian. Our clients do not pay any account custodial fees and do not pay any stock nor ETF trading commissions. Just don't do it. 3. Do not pay an upfront load when investing in a mutual fund. A load is simply another word for commission. Don't pay them. Instead, seek out no-load and institutional mutual funds and the financial advisors and advisory firms who recommend them. 4. Pay close attention to any hidden fees found within your company-sponsored retirement plan. Ask to see the summary plan description, also known as the plan document, of your 401k, 403b, 457, or TSP plan. Review it for any plan-based fees that are borne by you as a participant. Additionally, if your menu of investment choices is a limited selection of high-expense, high-fee funds, ask your plan administrator why and inquire about what lower-cost options are available to you. 4 valuable ways to reduce your investment expenses and get better gas mileage for your portfolio. Capiche? If you found 1 or 2 of them valuable, let us know by clicking that thumbs up button. And also, please leave us a comment. Here at Towerpoint Wealth, we are not sure which we detest more, investment expenses or income taxes. However, reducing and minimizing both of them is an opportunity and a significant responsibility of properly managing, protecting, and growing your net worth. There is no question that the drag created by these 2 necessary evils reduces how far your money will go, but fortunately, you do have direct control over the application and implementation of the strategies that I've mentioned. Does today's completely unsettled world have you worried? Do you have questions or concerns about the structure of your own portfolio? Don't hesitate. Reach out to us. We're happy to have a conversation and just begin to get to know you. And lastly, if you found this video useful and would like to receive more high-level financial and wealth-building content like this, hit that subscribe button to subscribe to the Towerpoint Wealth YouTube channel, and then hit the bell button to receive an announcement when our next educational video drops. Thank you for watching.